have Alex Chaia from Catalyst Futures, the managing partner of Catalyst Futures, here to discuss his book.
Nice to see you again, Fred.
Nice to see you, Alex. Always a pleasure. And what I want to talk about in the last video that we did, we discussed the CFST Master Trader course and the book that you wrote about it. Can we delve into each chapter of that course and discuss in a little bit more detail?
Absolutely. I would be happy to.
Okay, very good, because I know there's a lot of information there, and it's very comprehensive, as we've said in the last time. When I browsed through chapter 1, I saw some acronyms. Maybe you can explain the difference between an FCM, an FDM, or an RFED. And just to preface this first chapter is really on compliance and oversight and regulatory. Is that right?
That's right. So yeah, that's actually chapter 2 of the book. Of course, the chapter 1 is more like an introduction saying how the exam works.
Yeah.
But we discussed this last time. But chapter 2 is about derivatives compliance, right? So it will cover ethics and professional conduct of derivatives professionals and some of the U.S. regulation. So the Commodities Exchange Act, NFA, exchange rules. And then it dwells a little bit in European derivatives regulation and emerging markets Brazilian regulation, India, Dubai, Singapore. So it's very comprehensive, but it's short. It's really like just covering because a lot of this regulation is really common across the different exchange venues.
So you could basically go a lot deeper if you like, but this gives you an understanding of what's in the book and what's available, what the information you need to know.
Precisely. Yeah, no, but
So right now, FCM, FDM, RFED.
Sounds good. So FCM is Futures Commission Merchant. So that's an acronym for Futures Commission Merchant. And an FCM is, a lot of people call different names like clearing or broker. But what it is a company that accepts orders to buy or sell futures contracts, options on futures contracts, sometimes as well like retail forex contracts or swaps. So it's
who authorizes that?
So
is that the NFA?
So they are CFTC regulated and NFA registered. So the NFA is the National Futures Association, and every firm in the United States that want to deal, offer, or participate in the futures and options on futures market must be a member of the NFA in some sense. It's what it's called a self-regulatory organization.
SRO,
yeah.
Yes.
Now, the CFTC, which is the actual government regulator, delegates a lot of its functions to the NFA to apply it. The CFTC was created by Congress in 1975, and the NFA in 1982. So a lot of the Commodities Exchange Act you can find online on the CFTC website, and the NFA regulation. There is a rule book of the NFA available on their website as well.
Okay, and what does it cost to how difficult does it become an FCM?
Well, they have a lot of requirements and a lot of reporting to do for the NFA and the CFTC, no doubt. But there's the adjusted net capital, which needs to be $2 million. So basically, the adjusted net capital, putting it very simple, is the customer's capital minus what they have as their own shareholders' capital. They must have 8% of the customer's risk maintenance and margin performance bond for every single domestic or even foreign derivatives that they trade. So if they decide to offer not only the US exchanges like CME, they decide to offer Eurex or Chinese futures, they must have 8% of the customers' risk margins with their own capital, right? So
And you mentioned earlier $2 million. Is it a minimum of $2 million?
yeah, the minimum adjusted net capital. Every time they are close to that, or if they fail to maintain these at least, they are in trouble. If they offer swaps, if they're like swaps dealer, this goes to $20 million, right? And I think there is some movement that to increase those numbers. But it's very important for futures traders to understand this 8% customers risk maintenance margin, because this is usually the math spread that the FCM will use in order to price how much they are going to charge in commissions, because they know, oh, okay, this guy uses $10 million in margin. This means I need to put like 800 grand in capital, and so they will see like, okay, how much this will capital cost me, right? And that's how they base the minimum fees that they are going to charge you.
How does this differentiate from an FDM or an RFED?
Well, an FDM is a forex dealing member, so they are not offering or accepting orders to buy and sell futures contracts, but off exchange foreign currency, which is an OTC market.
And that's the rolling spot contract.
That's right. That's right. Or forwards as well, like on FX, or options as well on FX. And then because it's an OTC market, there is so much more counterparty risk. This is why their adjusted net capital goes up to $20 million. And then there are further requirements like 5% of customer liabilities, 10% of all liabilities that they have with different counterparties and affiliates. So it's a tough
I remember
requirement.
when the retail FX market, the OTC FX market for retail players, was introduced back, I guess, around 1999, 1998. There were hundreds of U.S. retail brokers, and then slowly, because of some of the unscrupulous brokers around, they were getting weeded out, and I guess the regulatory bodies got so many complaints that they decided, let's continue to raise capital requirements and weed out the small players.
Yeah, I think the regulation, the requirement became so tough that I think there are like 4 or 5 FDMs at most nowadays. So it's a good market.
And the support and bookkeeping that needs to be done and reporting that needs to be done was overwhelming.
Yeah.
So what is an RFED?
An RFED is the retail foreign exchange dealer. So this is a customer that not only accepts orders on off exchange currency like spot FX, but also accepts retail customers' orders. So they are able
to be an
Go ahead.
To be an RFED, do you first need to be an FDM?
Absolutely. So the RFED also is able to have individuals and retail customers as counterparty, and even perhaps do some promotion, of course, under a lot of requirements, not promising performance and things like this. But most of the entities dealing in FX in the US, they are both. They are FDMs and they are RFEDs.
Right.
Yeah.
When I briefly read through the chapter, I noticed a couple of more acronyms that I think we should address. The concept of an IB, a CTA, a CPO,
Excellent.
and an SD. Can you explain those?
Introducing broker is, you must know this very well, Fred, having worked in the spot FX industry. The IBs are absolutely essential to bring customers to the FDMs or FCMs. So IB is able to accept orders to buy and sell futures contracts. But what he does basically is to introduce that customer to the clearing broker, or
And the IB doesn't hold any funds. He doesn't do any KYC.
precisely he has some KYC responsibilities, no doubt, and but they do it on a fully disclosed basis. So they need to review all their customers, very detailed, do the KYC as well, be part of the KYC process with the FCM or the RFED. In the US, they need to maintain a minimum capital as well, and that's $45,000. In most other jurisdictions, there is no such capital requirement, but in Europe, they need to be regulated as well, and it's a tough regulation. But in the US, it's $45,000 adjusted net capital. They also are exclusive. They cannot just introduce customers to multiple FCMs most of the times. So if they do introduce to multiple FCMs, they have tougher regulation as well. But the guarantor, the one who receives the funds, is the FCM or the FDM or the RFED. So the introducing broker is basically a salesperson that has some independence from the broker. Yeah.
Right.
You mentioned a swap dealer as well, right? So this is a company that deals in swaps. Basically, swaps are OTC contracts between institutions. So the example, very common example, is a company that exports. Let's say they import stuff from Mexico, so they need to do a swap because they don't want exposure to the Mexican peso. So they go to a bank or another counterparty and do this derivative transaction. In this case, the requirements are pretty much like the FDMs, so they need to have at least $20 million net capital. Yeah.
That's right. Swap dealer, IB, and then we have CTA and CPO.
Yeah, that's my favorite category. So a CTA is an acronym for Commodity Trading Advisor, and that can be either an individual or a company that advises customers about trading futures contracts or foreign exchange contracts or swap contracts, derivatives in general. So a CTA usually has a power of attorney over a customer's account. He's a money manager. That's another name in other jurisdictions. And he has a lot of reporting to do. They need to report capital ratios. They need to report performance monthly, quarterly. They also cannot accept funds from customers. So the funds stay with the clearing firms, with the FCMs or FDMs. The accounts must be in the customer's name, not in their name. But they have a power of attorney. Or sometimes they don't have a power of attorney, and all what they do is like giving signals or providing hedging advice. So their CTAs specialize in hedging. So they help an agricultural producer like how to manage his risks, so they don't have direct power of attorney. But most CTAs manage accounts for institutional clients, trading futures, trading options on futures.
So they'll advise, but he has access to the account in order to execute trades, open and close, but he has no access to call for a redemption or deposit. He doesn't have any of those. It's view only in terms of that, but he does have executory power.
Yes, of course. Yeah, he can give such orders if it's in his scope, but as an advisor, right? So like, oh, my customer wants to withdraw that amount of money from his FCM account. He can probably give that instruction, but of course it's not his account, it's a customer's account. It's all very ring-fenced. There is a lot of requirements for this. To be a CTA, you need to pass the Series 3. Depending on your function, there are other different series exams that you need to pass. For somebody doing this with Forex as well, there's a Series 34, which is an additional exam that you need to take. And there is a very important document that if you are thinking about hiring a CTA, you always need to ask this document. It's called a disclosure document. That mentions every single line cost that they charge to your account, all the potential risks, conflicts of interests, if they ever had some criminal background. It's very rare, but sometimes happens in people's lives. And they need to disclose that they had a situation with the courts or something like this. So the disclosure document will tell you a lot of detail about the CTA. This goes to the NFA for review. The NFA doesn't approve a disclosure document or disapprove, but they won't allow you to go into business until they are reasonably satisfied you are telling all the truth there, and disclosing everything that needs to be disclosed. And then they collect like fingerprints, like there's this FBI fingerprints. It's very tough regulation, but if the guy is a CTA and he went through this, it's usually a very good sign.
CPO, what's a
CPO?
Commodity pool?
CPO is another name for hedge funds, basically, because the CPO is an acronym for Commodity Pool Operator. A CPO, he establishes a partnership, or an LLC, a company, really. This company is denominated a commodity pool, and the commodity pool operator, the CPO, manages that pool. So he takes decisions on which futures contracts, options contracts are going to be traded. The reporting and the requirements are very, very similar to the CTAs, with the big difference that a commodity pool operator will operate a commodity pool. That means a company where other people invest, they send money to the account of that company, and they subscribe not only the disclosure document, but like an indenture or a document like subscribing the shares of that hedge fund, basically.
So as I understand it, a CTA will deal individually with each client. You deposit $10,000 with me, I can execute trades on your behalf and hopefully break that 10 to 20 and so forth. Whereas a CPO, if he's got 10 people that each deposit $10,000, he puts $100,000 in a pool, and then everyone has 10% share of that pool.
Precisely, they have shares of the pool.
So it's not individual trades that he's doing for each client as a CTA, but as a CPO, it's one trade that executes, and then he has a back office operation that will break that down.
That's right. So he has more reporting to do. So like usually investors will require that commodity pool to be audited by a big four firm or something like this. So they have more. So there is much more counterparty risk, of course, because the commodity pool can, as a company, can go bankrupt.
Right.
Like it's not your account. It's the account of that company that is being managed. So it's less. I wouldn't say less transparency, because there can be a lot of transparency, but a little bit of more. There's more counterparty risk, and more chances for fraud as well, because I mean it's a separated, less transparent entity. But also what can it's a more difficult setup, but the manager might require that, because some strategies are not possible on small accounts, or need to really pull resources from different customers. From a management perspective as well, just think the guy is a professional investment manager, professional commodities trading advisor, and instead of managing 100 accounts, this takes much more. This is much more difficult from a risk management perspective. It's better to pull everyone in one vehicle and that's what the commodity pool operator does. Yeah.
And I know you have a section of the book that talks about common account types. I don't think we need to spend a lot of time on it, but basically individual accounts, corporate accounts, joint accounts,
Yeah, so
right?
yeah, they're very simple. We can go quickly through this. Individual account is your account, just one person.
Right.
Then you have corporate account with accounts for entities. These are accounts with FCMs or FDMs or RFEDs, right? So you have different types
Right.
of accounts. Joint account when you or your partner open this account together. Very common for couples and families. Then there's the trust
Yeah.
account, which you have a settler and a trustee, like someone who is the manages the
Right.
trust and someone who is the beneficiary of the trust. So this can be done for many reasons, like the asset protection and things like this. And then there's like a few more complicated and less common types of accounts that might be interesting to know. So there is one called the GTIC, the Joint Tenants in Common. That one is like if one of the party dies, all the assets of the tenant who has died become the property of the descendants. So and not the property of the surviving tenant. So basically, it's like okay, let's say someone and his wife open a joint account. If one of them died, the assets are not from the partner, but from the descendants, the sons and daughters. So and then you have different, a little bit more complicated accounts, but this is all very detailed in the book.
Yeah. For our purposes, just a quick oversight,
Yeah,
something to be aware of. Something you discuss, OFAC, red flags, and SARs that brokers, I guess, have to abide by and oversight of.
fact. Sorry, fact.
I know there's an OFAC list of countries that you can't deal with.
Absolutely, and this list changes both for uh, political reasons, but also for uh, issues such as money laundering or the rule of law on the countries.
And this is more geared towards the broker or the RFED themselves, not the individual. You know, unless you're from North Korea or Syria and you
Yeah,
can't get an account, if you have dual citizenship, maybe you can get it from somewhere else. But if
absolutely.
you have one of on that from a country on the OFAC list, it's going to be impossible to get an account with a Western
Well, it
broker.
should be impossible. Sometimes it happens, but it can happen because people may lie as well and provide like fake documents. So, of course, the FDMs and FCMs need to pay a lot of attention. There are systems to detect this, but sometimes something goes through. OFAC stands for Office of Foreign Assets Control. It's part of the U.S. Treasury Department, and this a mistake there can be very costly for FDMs, RFEDs, or even CTAs if they facilitated the transaction, let's say. So what happens is a lot of people take insurance policies to in case something unexpected goes through, like a client or something. But people can go up to 20 years in prison or pay $500,000 for each line transaction as a penalty for this. So
And that's really all about money laundering, funding terrorist groups, right? So you want to keep honest people honest, essentially.
exactly. Proceeds of criminal activity, terrorism, and things like this. Yeah.
And the red flags, that's once again another money laundering term.
Yeah, red flags are basically the things that can
Stand out
stand
and
out.
make somebody look a little deeper.
So there is a duty to capture those red flags. There is a lot of communication and training from the NFA, from the CFTC, and from the groups of FDMs and RFEDs and FCMs to and the IRS as well to understand what are all those red flags. And this can be like I don't know, even if from you know a small issue with the photography of the document, or and now with AI, I mean, I imagine this is getting really, really complicated.
Right.
But yeah, all those red flags, different name or person changing the name twice, all these are red flags, which are not necessarily a problem.
Just means there's more scrutiny,
Yeah,
that's all.
most FCMs will not just reject an account because they're of a red flag, but they will require more. And you must know this as well. A lot of clients may feel like uncomfortable with the level of scrutiny they're getting. Like, oh, why is this broker? I just want to open an account to trade. Why are they asking me all these questions? Well, they're asking because there was a red flag, and it's their duty to explain. Otherwise, they can go to jail or pay $500,000 for what you do. So
You have nothing to hide, don't worry.
exactly,
Yeah,
just respond to
no
the
legitimate.
questions calmly and take the time, and after you go through it, your account will be open. No
Now, yeah,
problem.
I saw some other terms in the book that I thought were interesting, that were quite widespread in the over-the-counter institutional FX markets many years ago. The term wash trades and prearranged trades. We used to have a wash trade. We used to do a wash trade where, banks had credit limits to one another, and you reach a credit limit, and it was not common for Citibank and JP Morgan to run up to their limit and not get that dealt with. But you would have a trade like Citibank and National City Bank of Cleveland,
Mm.
or some smaller entity that has limited capital. So the over-the-counter brokers would come in and say, Fred, can you deal with City? Yes. Can you deal with National City Cleveland? Yes. Okay, can you stand inside of this trade? So you deal with City, you deal with that City Cleveland, just so we can execute this trade. And there's no payments made. There's no, it facilitates the gears. It lets the market trade rather than everybody being stuck trying to find a counterparty. But I guess in the futures market, it's a little different.
Well, yes and no. There are many jurisdictions that actually wash trades are allowed. Even there's no
Yeah,
a problem about that. But in the United States and in Europe as well, and the LME, and so in different jurisdictions, wash trade is something that, under the suspicion of wash trades, the investigation tries to go deep. And it can have penalties. It can have different types of penalties and levels and trials and things like this to decide some of the things, like was it intentional, or was it a mistake, or what was it? Because a wash trade is essentially a trade that was not done in the intention of just fairly participating in the market and taking prices or running market risk.
yeah, I can understand where I'm going to buy from you at this price. I'm going to sell it back to you, but I want to make sure that print shows on the screen.
Yeah,
So,
it can be that somebody's trying to transfer equity between accounts. It can be that someone, like prearranged something with someone, like they see the order book is empty, and a guy calls the other, like, look, I want to do this such a trade. Can you put your order there? And then immediately hits that particular price. This is a pre-arrangement and can be seen like just two people
manipulating the
manipulating the
market.
market, especially if the price is not exactly the market price. Where it gets difficult is that for some instruments, for some asset classes, there might be no market for hours,
There's no
no
liquidity. Yeah.
liquidity, like a crazy option at some expiration or something. So when that happens, there is an investigation. The CME usually investigates itself and its self-regulatory powers, the ICE as well, asking questions for the traders. They see the tag ID of the exact traders that did, the time, and try to understand what happened. And even if it's a mistake for risk management or something like this, which happens a lot, there are penalties involved, and yeah, it can be sizable.
You have a couple of other acronyms, and I think this is more, once again, on the regulatory side. MiFID, MiFID II, and ESMA.
Ah, yeah.
You want to just touch on those?
ESMA is the European derivatives regulators. It stands for European, not only derivatives but capital markets as well, the European Securities and Market Authority. That started out in 2009. It's not completely formed yet, ESMA, because each country in Europe, like France has AMF, Italy has the CONSOB, so there are different regulations in each country with their own rules, with their own approval process, but this seems to be converging into ESMA. And they are completing a rule book for the whole European Union financial markets to facilitate, equity listings, derivative listings, credit ratings. So it's the European regulator, and I think people will hear more and more this name once the markets are
So
unified.
if you hear the term ESMA, just understand it's the regulatory body, similar, I guess, to the CFTC.
Well, that's the intention, but of course, because it's so different countries, different languages, and everybody's a bit protective about their own capital markets. Somehow they still don't have the whole thing fully formed, but I think it's converging to that. And once that happens, it will really transform the European capital markets, because then when you list a stock or something, you list for the entire market. You don't have to go to each regulator individually, and
MiFID and MiFID
yeah,
II.
MiFID is Markets in Financial Instruments Directive. It's the cornerstone of European regulation. It's like how business are supposed to run in terms of investment management firms, authorization requirement, reporting requirements, transparency, etc. Think of MiFID as the European Commodities Exchange Act. So that's for the derivatives traders. That's what it is. It's the main rules.
What was that first introduced?
That was 2018, so it's fairly recent.
Okay. And MiFID II is newer than that, I would imagine.
Yeah, it's a
Second
revised
iteration.
version of MiFID with a lot of improvements for more fair markets, more efficient markets, different reporting requirements, made it easier. The reporting some aspects made it more difficult in others. So it's an evolving document still, but that's the principal derivatives guiding document and regulation.
So if investors, European investors, hear the terms MiFID, MiFID II, or ESMA, just understand it's the regulatory body, the oversight body. It's there to protect you, to help you. It's not there to cause concern. Well, Alex, I think this, once again, has been a great overview of the chapter. If anybody's looking to take the CSFT Master Class test, these little snippets that we're doing will give a great overview along with the book, along with each chapter. Once again, partnering with FXAQ would be a great opportunity. We did a little short that came out last week. Trade as you learn,
Yeah.
So basically you can execute, learn while you're trading and putting all of this together. So I want to thank you for your time. Once again, we'll do this again quickly, shortly. We can put together chapter 2 and 3 and go on until we've addressed the entire book.
And just a reminder for people watching that if you enter one of the FXAQ challenges, you might get the CFST exam participation for free, and also the more in-depth book and contents about training for the CFST exam.
Yeah. All right. Well, thank you. Have a great afternoon. Continued success trading, my friend.
Sounds good. Speak to you soon. Bye.
Okay. Cheers.